Out of the States, Deutsche Bank reportedly plans to restructure its U.S. operations to skirt new financial regulations that could force it to raise billions of dollars. The Journal says executives are concerned that the bank would need $20 billion to offset losses at its main U.S. unit called Tanis. Under its plan, Deutsche Bank, which they submitted last year to the Fed, by the way, Tanis would basically give up its bank holding status, its banking division, Deutsche Bank Trust, and would become a direct subsidiary of the German lender. We're joined now by Bill Isaac, a senior managing editor at FTI Consulting, chairman of Fifth Third Bancorp, and former FDIC chairman. You have a lot of jobs these days, sir. Miles Nadal sticks around as our guest host. You're not a fan of Dodd-Frank. You've written about it extensively. You say it was a missed opportunity. What, though, would be the unintended consequences if banks need to make up and replace that lost $25 billion?
Well, the Dodd-Frank is a missed opportunity. We had a chance to really reform the financial system so that we didn't come back into another crisis in a few years. Dodd-Frank didn't do anything to prevent the next crisis from happening. Wouldn't have prevented the one that just happened. So it was a missed opportunity. One of the serious effects, though, in terms of the banking system is it imposes some 10,000 pages of new regulations on the industry. It's going to be enormously expensive, and it denied smaller banks access to the capital that they had been using to grow. And smaller banks are the primary source of small business lending in this country.
Right, so something we could see would be smaller banks closing or merging together because they would have to abide by higher capital requirements, less bells and whistles when it comes to free checking or bank tellers, for that matter. But what concerns me most, and tell me if it gets to this point, is the less complex variations of financial products. So essentially reducing, the risk of competition for hot money. Is that a possibility?
Well, actually, I would really appreciate the less competition for hot money. The banking system is using too much hot money. I also am not opposed to higher capital standards. They didn't really raise the the capital standards for the smaller banks. They were already high. What they're trying to do is bring the larger banks up, which I endorse wholeheartedly. That doesn't really have anything to do with Dodd-Frank. We could have done that by regulation, and are doing that by regulation without Dodd-Frank. What Dodd-Frank did is it prohibited smaller banks from issuing a thing called trust preferred stock, and that has been a primary source of capital for small banks. I don't know how the small banks are going to grow, and if they don't grow, we don't have a lot of small business lending in this country.
Well, I have a question for you. You talked about smaller banks. I mean, from what I see in the smaller bank CEOs that I talk to, they're just trying to survive, let alone grow. And it seems to be death by a thousand cuts, that there seems to be every week more and more small banks that are eliminated. When do we get to terra firma, where the small banks that are going to survive, and then start to grow? Where is the regulation in relation to really a commitment and dedication to say, okay, we're going to eliminate 1,000 other banks below this threshold, and then we're going to support the ones? It doesn't seem like there's a clear policy, and Dodd-Frank has not done anything other than create uncertainty with small banks. And as you said, there is no lending to small businesses. So what's the solution?
Well, the solution is to recognize that small banks are critical to our economy, and to the community banks are really important to a lot of towns and cities smaller cities around the country. They are the heart and soul of those communities, and we have had a policy over the last 20 years of not really caring about the small bank and imposing one size fits all regulation on them, large banks and small banks alike. The typical small bank is like 1/10,000th the size of Bank of America. Yep. It's just a very, very small fraction of Bank of America, but yet they have to comply with all the same regulations. One
of the fascinating things that you said in the break was that Dodd-Frank did not address too big to fail. But that's what the consumer, that's what the American people were hoping that Dodd-Frank would address. Why didn't it, and what could address too big to fail?
Unfortunately, we're going to have to leave it there. I'll leave you guys on a cliffhanger. We have to, we have to get to commercial break. Bill, we're going to invite you back on. You guys need a show together, I think.
Yes, I think so.
Thank you so much for your time this morning, and Miles sticks around as well.